Hey everyone, welcome to the channel. I decided to make this video because over the years I had many conversations with friends and acquaintances about index funds. There's a lot of confusion about what they are, how they work, and why so many long-term investors use them. This video is meant to clarify that. To explain index funds in a simple, structured way and to explain why they play an important role in long-term investing. So what is an index fund? An index fund is an investment fund designed to track a specific market index. For example, the S&P 500, which represents the 500 largest publicly traded companies in the United States, a total stock market index, or international market indexes. Instead of trying to identify winning stocks, an index fund aims to replicate the performance of the index it follows. The idea is not to beat the market. The idea is to own the market. Most index funds today are offered as ETFs, exchange traded funds. ETFs trade on stock exchanges just like individual stocks. But instead of owning one company, you own a diversified portfolio of companies. These funds are passively managed. That means fund managers do not make frequent discretionary decisions. There is no stock picking or market timing. Buying and selling are rule-based and largely automated. For an S&P 500 ETF, companies are weighted by market capitalization. Changes in the index are automatically reflected in the fund. The fund's job is simply to track the index accurately. Most broad index funds are market cap weighted. This means your investment is allocated based on the size of each company. If you invest $100 into an S&P 500 index fund, the largest companies receive the largest share of your investment. Smaller companies receive smaller allocations. You are not making individual company decisions. The market determines the allocation. Over long periods, broad US index funds have outperformed many other assets. Historically, indexes like the S&P 500 have outperformed cash, treasury bills, many bond investments, and the majority of actively managed funds over time. This outcome is largely driven by broad diversification, low costs, and consistent participation in market growth. Largest index ETFs by assets under management. When selecting an index fund, a few factors matters most. First, expense ratio. Lower costs have a meaningful impact over time. Second, asset under management. Larger funds tend to be more stable and liquid. Third, tracking accuracy. The fund should closely follow its underlying index. For taxable accounts, ETFs are often more tax efficient than mutual funds due to their structure. Investing in index funds means broad diversification, reduced dependence on individual stocks, and exposure to long-term economic growth. Over time, compounding becomes the most powerful factor. By staying invested and minimizing decisions, risk is reduced, cost remains low, and returns compound more efficiently. Index funds are not designed to be exciting. They are designed to be effective. If your goal is long-term wealth building, understanding index funds is an important foundation.